What's good, everyone, and welcome back to the Financial Forward channel. Today, we begin the fundamental analysis portion of the free money glitch stock course. This is one of 4 parts total, okay? Obviously, the fundamental analysis portion is the first part. Then we have the second part, which is the technical analysis portion. Then the options trading portion, and finally, our glitched out scalping section, where you will officially become the glitch in the system, a master of the stock market. So before we get into the nitty gritty, the fundamental analysis portion is the most important, okay? You cannot skip this portion because it's meant to help us understand how the stock market works, all right? We need to understand how the market operates so that when it's time to make moves, we know exactly when and how to make those moves. And so in the first part of the fundamental analysis series, we will look at how the investment markets operate through something called an economic cycle. And we'll also look at the investments that traditionally perform well at different phases of the cycle. So grab your notebooks, hands and feet aside the right at all times. Let's go glitch this money, baby. All right, so an economic cycle is the fluctuation of the economy during periods of expansion and contraction. These are there are 4 total phases of the economic cycle. There's expansion, there's the peak right before a recession, contraction during a recession, and a trough or a bottom at the end of the recession. So let's break these 4 down. The expansion, this is when consumer spending really helps the economy expand. So you got larger purchases like cars, houses, non-essentials, general spending. They all have a big impact on the state of the economy. All right, so when the economy is expanding, more people are looking for jobs and new business begin to start. This is the expansion phase, okay? Obviously, we're not here right now currently. 2020 going into 2021, that was an expansion phase, okay? Phase 2 is the peak, and this is where businesses will typically still be thriving when the economic peaks reach this point, but they will start to encounter different costs and pressures that weren't present at the beginning of the expansion phase. So due to new businesses competing for the same customers and the increased demand for skilled labor, the competition is fiercer at this point. This was definitely 2021, okay? And to reduce the risk of inflation in a strong economy, sometimes central banks will frequently increase interest rates, and this puts additional pressure on companies, which they must pay more interest on the money they borrow just to stay afloat, all right? And as a result, customers are forced to pay more interest on large purchases, okay? Then comes the contraction, which is phase 3. And this forces companies to cut production in order to stay competitive. So as of June 2023, currently we are in a contraction phase, all right? There's a decline in production levels leading to a reduction in the number of employees. And due to employees being a simple cost that can be reduced by businesses, employment numbers typically decline early in the contraction phase, okay? Because of this, one of the most important news releases is the non-farm payroll employment numbers, okay? Non-farm payroll is released for the previous month on the first Friday of every month. Also, investors pay close attention to the new housing starts report when they are trying to predict when a recession will end. All right. And then finally, there's the trough or the bottom phase, which is the final stage of the economic cycle. Now, this is where businesses are at their most desperate, and they'll start slashing prices in the effort to get rid of any remaining inventory and boost cash flow. Also, this is the time when central banks attempt to end the recession by lowering interest rates, right? And so consumers who have been delaying purchases. They'll start to spend money when the weight of business and industry decreases, thanks to low interest rates and cheaper homes and appliances. This is certainly the time to buy into the market, okay? Now, there are some key measures of an economic cycle. Economic cycle has important metrics that need to be understood. One of those is GDP, which is essentially represents a nation's market value of all the finished goods and services produced during that specific time period. So the GDP data, which is released every 3 months as a percentage, it basically illustrates how each nation's economy is performing in comparison to expectations and its past performance. Okay, so a rising GDP number shows that the economy is still expanding because the market value of the goods and services is rising. Okay, a declining GDP number can indicate can indicate a decline, basically, in a nation's production output. While a stagnant number can indicate a flattening or a tightening of an economy. It basically directly correlates with the economy's health, okay? And then, of course, there is inflation. Now, we all know what this is, but for those that don't, the rate at which the cost of goods and services rises is known as inflation, okay? It is possible to think of inflation as the rate at which prices change from one period to the next, right? And it's calculated as a percentage of the consumer price index, aka the CPI number. When the cost of home or household goods rises from year to year, the same dollar amount spent buys fewer and fewer goods than it did the prior year. So, for example, in 2018, $1,000 could buy you 6,600 pounds of grain, right? But the next year, in 2019, the same amount could buy you 5,500 pounds, okay? So when the cost of goods and services decreases from one time period to the next, this is referred to as deficiency, okay? Now, since rising inflation directly affects the cost of living, a lot of economists believe that the best case scenario for inflation is a zero to marginal increase. If inflation is higher than wages, consumer spending will decline, which will be bad for the economy. But to make sure it doesn't endanger a booming economy, what central banks and governments will do is they'll closely monitor the measure of inflation during periods of economic expansion. Okay. Next is our interest rates. All right. Interest rates are basically a tool used by central banks to stifle economic expansion. Okay. So the central banks, what they'll do is they can increase interest rates when the economy is expanding quickly to slow that growth and lower the risk of inflation. A rise in interest rates will basically cause businesses and consumers to cut back on their spending, which will impede economic expansion. Okay. The central banks can use lower interest rates to stimulate the economy, while businesses can use the lower borrowing costs to expand it. Okay, which results in an increase in production output and employment levels. Consumers can access lower borrowing costs to buy expensive items like houses or cars or something. Then there's the employment numbers. Speaking of which, the employment situation, it has a current impact. It has a very big impact on the state of the economy. It's anticipated that unemployment rates will fluctuate as the economy changes. The employment rate will decrease when the economy is strong, because more employers will be hiring, right? In a struggling economy, businesses try to lower operating costs by laying off workers, okay? So due to its tendency to follow changes in the economy changes in the economic cycle, the employment rate is regarded as a lagging indicator. And so over time, consistent increases or decreases in unemployment rates can signal the end of a peak phase and the beginning of the trough phase, okay? But in most cases, the stock market starts 3 to 6 months before the economic cycle. So since a share market can turn bearish more sooner than an economic cycle reaches its peak, unemployment data may be a lagging indicator for an economic peak, but it may be very helpful to identify a share market peak. Finally, we have here consumer spending. So basically, all developing economies depend on consumer spending. When consumer spending is high and demand outpaces supply, businesses will prosper. And because of the higher demand, companies can charge more for their products and services, which increases their profits, right? A growing economy can't benefit from low consumer confidence, which is reflected in the spending. So it's pretty obvious that rising consumer spending will contribute to rising GDP levels, because a country GDP may suffer if consumer spending levels decline, okay? So now let's look at how all that stuff plays into the stock market investment, because it would make sense that certain stock market investments would behave differently at various points in the economic cycle. So we'll look at some of the investments that have performed best at the various economic stages. So first is the trough phase. So in the trough phase, this is where interest rates are still generally declining because the market is still in the process of emerging from a recession, which will help a struggling economy by adding money flow and liquidity, right? This is when borrowing money is more affordable, which allows companies to grow and produce more. And this is also when the economy gains momentum because consumers spend more. Also during this stage, this is when financials do really well. Bank of America, JP Morgan Chase, because both consumers and businesses are willing to take on debt, right? And this is also when the housing industry and the auto industries, they're doing well because due to decreased borrowing costs and price reductions by businesses, consumers can resume purchasing large ticket items. So then you have the expansion phase. So basically, corporate profits are reaching all-time highs as the economy begins to expand as a result of rising demand and low interest rates. Investors will begin to focus on longer-term opportunity as consumer spending is already rising and fear from the previous recession begins to dissipate. You got industries like manufacturing, logistics, infrastructure development firms that begin to do well during this stage because profits for these industries rise as a result of rising business activity and government spending. And then you have information technology begins to perform well in a growing economy because there is a higher demand for new and improved tech, which lowers unemployment rates by boosting productivity, right? And so a growing economy can lead to an increase in commodity prices. You got gold, copper, oil, which are some examples of basic material that are being used more frequently as a result of rising manufacturing demand and expanding infrastructure projects. And so then you'll have the second half performance, which is basically when consumer spending and confidence begin to decline. So first you'll have the You have the peak phase, which at this stage, worries about a recession start to surface in the news as the market starts to appear really hot and stretched out and overextended. As the market appears to be expensive, inflation is decreasing. Also, in this phase, energy and utilities typically perform well because people still need gas and electricity to survive, and consumer demand for the services these industries offer isn't drastically reduced. Uh, then you also have healthcare and consumer staples industries typically doing well. Then the market, because consumer demand remains constant despite the fact of stock market performance and talks of a recession. These industries, which are also referred to as defensive, have a long history of delivering reliable performance during the times of market weakness. And then the final stage, which is basically the contraction phase. This is when a slowdown happens in business profits and economic activity begins to dry up, which results in higher unemployment and decreased consumer spending because of high interest rates and a significant correction. This is when the market is bearish, okay? Because of their defensive qualities, investments in energy and utility sectors, as well as healthcare and consumer goods industries, are typically preferred during the contraction phase. The contraction phase typically lasts no more than a year, and historically, it's been shorter than the expansion phase, okay? And then all this does, it circles back to the trough phase again, okay? And so in order to start preparing for investments that perform best at the start of the next cycle, we as investors need to be on the lookout for signals of the beginning of the trough phase, okay? This finishes off our first section, the Free Money English fundamental analysis portion. Next, we will learn about the second part of fundamental analysis, sector analysis. This is Bradley Barnett. I love y'all, from yours truly, Financial Forbes.